Ladies and gentlemen, let's make some noise for Mr. Hemen Bhatia, Head ETF, Nippon India Mutual Fund.
Good afternoon, everyone. So the topic I'm covering is 360-degree view of ETF, and the time I have is 15 minutes. So I'll have to make it fast. My presentation is divided into 3 parts. In the first part, I will be covering or speaking about the popularity of the ETFs globally as well as in the Indian markets. In the second part, I'll be covering about introducing the ETFs and covering the use cases of the ETFs. And finally, after covering various parts, we'll be discussing on how to choose a ETF out of plethora of funds which are benchmarked to a particular index. Let's start the presentation with a quick quiz. Can anybody guess which is the top traded security in US markets? Anybody? 30 seconds for the answer. Right. So this is a list of top 25 traded securities on the US stock markets. And as is seen, out of top 25 traded securities, 14 securities are ETFs in some or other form. It may be large cap, it may be leverage, it can be S&P 500, it can be total market, it can be bond ETFs, etc. Value-wise share of this ETFs in the top 25 securities was close to 33% around 20 years back, which currently is 51%. So out of top 25 traded securities on the US stock exchanges, 51% of the volumes is contributed by ETFs, which shows the popularity of the ETFs in the global markets. This is how the ETFs have grown globally. So as is seen in the chart, ETFs have seen a tremendous growth in past couple of years. So almost in last 7 years, ETF AUM globally has risen from 3.4 trillion to currently 9.6 trillion in March 2023. Again, talks about the popularity of the ETF as a vehicle than as compared to the individual stocks. Indian market is not different, I'll say. Yes, the start was little slow, but again, from March 2014 onwards, while the first government disinvestment ETF was launched, we've seen slowly and steadily the ecosystem getting developed around the ETF. And from March 2014 till March 2023, you can see the AUM has gone up from almost 11,000 crores to currently 5 lakh crores as of March 23, which is a growth of almost 50 times. Obviously, there are many factors which have contributed to this growth. Because we will be short of time, I cannot discuss those factors, but there are various factors which have contributed to this growth. Now let's get on to the next part, wherein we'll just talk briefly about the ETFs. A lot of slides may be repetitive, but we'll just continue and try and make some sense out of every slide. Again, ETFs, we say it is best of both worlds. Why? Because ETF trades like a stock on the stock exchange. At the same time, it operates like a fund. So if you see the left-hand side part, it is constructed to track an index. While I say index, it can be any index, say a Nifty 50, Nifty Next 50, Midcap 150. It is designed to track a particular index. It's open-ended in nature. You can buy and sell ETFs anytime like any other open-ended fund. The vehicle is very transparent. That's very important because since the ETF is benchmarked to a particular index, the index methodology is put out in public based on which the underlying stocks will be selected, and even the rebalancing which will be done in the future is based on the transparent methodology which is there in the public. Generally, the expense ratios of ETFs are much lower than the active funds. On the right-hand side, you could see it trades like a stock. So you have all the flexibilities which are available while you buy and sell any stock. For example, you can put you can trade at real-time prices, you can put limit order, you can put stop losses while you are buying or selling any ETFs. And similar to any other stock, the lot size for buying one ETF is just 1 unit. But again, the delivery has to compulsorily be in the demat account. ETFs are available only, you can get it delivered only in the demat account, similar to any other stock. Now, there's something unique to ETFs in terms of the structure, which makes it a superior structure, I'll say, as compared to the traditional close-ended funds as well as traditional open-ended funds. Let us understand that. Now, given that ETF is actually a mutual fund which is listed on the stock exchange, it exactly trades like a stock. You can buy and sell the ETF on the stock exchange like a stock. You will have buyers, you will have sellers, and you have stock exchange mechanism to facilitate the buying and selling like any other stock. Now let us take an example. What happens when there are too many buyers in an ETF, okay, on a particular day who want to buy a particular ETF at that point of time? The ETF will start trading at a premium to its real-time price. Now, how do you neutralize that premium? Is when market maker comes in. So the role of the market maker is actually to provide support liquidity on the stock exchange. So in our same example, when there are too many buyers lead to premium vis-a-vis the real-time price. Market maker will actually neutralize that premium, and by supplying the ETF units on the stock exchange. Now, from where will the market maker get those units? They will come to the AMC, subscribe, put a subscription request, take the units and supply it on the stock exchange as per the settlement cycle. Vice versa, when there are too many sellers, suppose if there are too many sellers on the stock exchange, ETFs will start trading at a discount to its real-time price. The job of the market maker is to support the liquidity, buy the ETF units on the stock exchange, to neutralize the discount, and ultimately the units which they have purchased on the stock exchange, they will come and redeem it with the fund house, and fund house will in turn sell the underlying basket and provide the proceeds to the market maker. So ETF is much superior structure as compared to the traditional close-ended fund because of the market making ability. Obviously, apart from market maker, it is the natural investors which ultimately provide liquidity to the liquidity to any particular ETF, because market makers may be common. Most of the market makers may be common across AMCs, but what will be unique is the liquidity of a particular ETF, which comes by the natural buying and selling and the investors who are participating in a particular ETF. Here what we have tried to put is the example wherein you can compare the real-time price with the price quoted on the stock exchange. So for example purpose, on the right-hand side is the real-time NAV which is published. Generally the real-time NAVs for most of the ETFs are published on the website. So on the right-hand side is the real-time NAV. So we've tried to capture, say for example purpose, take a pharma ETF, okay? So the price which is real-time price is 12.8592. Any investor who is wanting to buy, suppose a pharma ETF, should see the real-time price, compare it with the quotes which are available on the exchange. So in this case, if somebody wants to buy a pharma ETF, the price at which they can buy is 12.86 and the price at which they can sell is 12.85. So roughly, real-time price versus the traded price has a difference of plus 6 to 7 basis points and minus 6 to 7 basis points on the either side. So always before buying an ETF, you can see the real-time price, see the price that it is traded on the stock exchange, just ensure that it is traded close to its fair price and then execute the trade. Now there are various use cases to ETFs. We saw on the panel which was discussing that as more and more use cases develop, there will be more and more investors participating. So let me tell you, there are various use cases to ETFs. We generally feel that it's a passive fund, so we have to be passive by nature and just buy and hold. No, that's not the case. There are various use cases and we'll quickly discuss a few of them. So ETF can be a very easy vehicle for doing your asset allocation. So suppose if somebody wants to invest, do asset allocation, invest in equities, fixed income and commodities, you have ETFs like Nifty 50, Next 50, Midcap 150 to complete your equity allocation. You have ETFs to do your, to diversify into commodities. You have gold and silver ETFs today. You even have multiple ETFs for fixed income allocations, wherein you can invest in constant maturity ETFs as well as target maturity ETFs. So asset allocation can very easily be practiced using ETFs. So that is one use case. You can very easily do cash equitization. Suppose if there's some active fund manager or any manager who is into buying or selling stocks or doing active strategies, they have come out of a particular strategy and they are sitting on cash. Now, till the time they decide their next move, if they have still not decided in which stock to invest, they can very easily equitize their cash so that they don't miss on the market movement. And the cash can very easily be equitized by putting into a simple Nifty 50 ETF, so that till the time you decide your next move, you don't miss on the market movement. So there's a use case for active managers as well here. Core and satellite we already discussed. Ideally, core part of your portfolio should provide the beta. Beta can come while you invest in index-based ETFs. On the satellite part, you can have anything basically which the investor or the advisor feels can generate alpha. It can be stocks, it can be AIFs, it can be PMSs, it can be active funds, anything which can provide boost to the investor's portfolio. You can actively manage a long-term portfolio using ETFs. Now, again, one more use case is there are multiple sector funds which are available. On IT index, you have sector funds on banking, auto, pharma. So if any particular investor has a view on a particular sector, they can simply buy an ETF rather than just choosing the stocks out of that sector. And once the view fructifies, you can very easily sell the ETF and take your allocation in the next sector, wherever the investor feels. So you can tactically use ETFs for your sector view. Finally, the last case which we have is actively trading ETFs. So even intraday traders, the traders who buy and sell stocks, they can very easily buy and sell indices using ETFs. Now you may not have futures on each and every index which is there, but you will have multiple ETFs launched on their index. So ETF can actually be very useful to a lot of those guys who are doing buying and selling stocks or who want to take intraday positions. Finally, generally the perception is that given that ETFs are benchmarked to a particular index, all ETFs are created equal. Let us quickly do a test basically of how to choose an ETF. So you can simply apply the Victor test before choosing an ETF benchmarked to a particular index. Now what is Victor test? V in the Victor stands for average daily volumes. Higher the daily volumes, better it is. IC stands for impact cost. Impact cost is independently calculated by the stock exchanges for ETFs and even for the stocks. Lower the impact cost, better it is. T is tracking error. Lower the tracking error, better it is. And ER is the expense ratio. Lower the expense ratio, better it is. So once you apply the Victor test, you will understand that although there are multiple ETFs benchmarked to a particular index, all ETFs are not created equals. We have just taken one simple example for illustrative purpose to apply the Victor test. Now let us apply the Victor test. V stands for daily average volumes. So out of say 16 to 17 funds, you have a fund basically showing average daily volumes based on 1 year and 3 years for various funds. So as is seen, fund 1 checks the test for the average daily volumes. Second part is the impact cost, which is calculated by the stock exchange. So the third last column is the impact cost. You can see the impact cost across ETFs. Lower the impact cost, better it is. So again, you check that box depending on which fund has got the lower impact cost. T stands for tracking error. Tracking error for most of the funds, top funds, is aligned, barring a few which have still, which may have still higher tracking errors. So again, for any fund which checks that box on the lower tracking error is the fund you should choose. And finally, the expense ratio. Expense ratios may be more or less aligned with each other. So a Victor test will allow you to choose an ETF out of the multiple funds which are benchmarked to a particular index. Important point to remember is don't see any parameter in isolation. See all the parameters collectively and then take the decision. So with this, I conclude my presentation, and my concluding remark is very simple. Beta is the new alpha, hence don't look for needles in the haystack, rather buy the entire haystack by way of buying an index through a ETF vehicle. Thank you.